All right. Well, welcome back. We are at Chimney Rock Mortgage today, which is located at 310 North Atlantic. That is Suite B, just in case you use Google Maps to get here.
Yes,
I'll take
we're
you
on
through-
the street, not upstairs.
Yeah, yeah. Hence 310 North Atlantic. So we're gonna go over a July recap for real estate, mortgage rates, and we're also gonna pose, I guess, answer everyone's question of, do you think rates are gonna go back to 3% anytime soon or ever? So we're gonna go over that. As always, I'm Rich with the Spokane Home Guy, and joined by
Mike Hogan with Chimney Rock Mortgage.
yeah, and it's almost GU basketball time.
It is getting close to GU
Yeah,
basketball
I
time.
think this next week
Yeah,
we'll get our
We'll get our bill
charitable
anyway.
contribution
Yeah.
bill, so that'll be fun. But anyway, so for the month of July, we actually saw, at least on the real estate side of things, some pretty, I would say, extreme silent changes in the market. I think most consumers are looking for either like a massive rate increase or decrease, or a massive, honestly, if you're a buyer, decrease in price. If you're a seller, increase in price. We didn't see that, but we saw something else I thought that was pretty interesting move in the month of July, and that is we saw inventory increase by almost 40% in the month of July, and we saw the number of months of inventory also increase by 36% in the month of July alone, which is big.
yeah. I mean, I think summer is usually a large listing time, but since homes aren't moving quite as fast, it's going to extend, the average days on market.
Yeah, and so if we look at the months of inventory, and we've been in fundamentally a seller's market for probably, I don't know, 6 years now, 7 years now,
Yeah.
maybe even a little longer than that. Probably, gosh, almost 10 or 12, I
Yeah,
guess.
it's really been a long time.
Yeah, so for the month of July, what was interesting in that is we went from, I think, about 3.6 months of inventory to 4.8, and that officially puts us into a balanced market. And a balanced market is a transitionary market. So there's going to be some sort of catalyst that either takes us back into a seller's market or transitions us into a buyer's market. And really, in our case, we've had low inventory, relatively, for the first part of the decade, or, baker's dozen, we've had pretty low rates. And so that's kept us in a seller's market. We've seen inventory increase and potentially demand start to slow or kind of wane a little bit, on the sales side of things.
Yeah, but at the same time, interest rates have come down from their peaks of a year ago. As July specifically, they actually slightly got a little bit better. But if you really look at all of 2025, rates have been fairly stable, right? They change from time to time, but they've remained fairly stable. And I believe that's kind of where they're going to end for the rest of this year, right?
Yeah.
I had a conversation with someone yesterday asking me, well, do you think interest rates are ever going to go to 3% again? And I really don't think so. The only 2 times they've gone to 3%, the Federal Reserve Bank was doing what they call quantitative easing, which is basically buying treasury notes and mortgage-backed securities, and it did lower the long-term rates. But the downside is that Federal Reserve Bank dramatically increased their balance sheet, and now as they're trying to decrease their balance sheet, they're flowing a whole bunch of treasuries and mortgage-backed securities into the market, and that is driving rates up, and it's also probably had a negative effect on inflation.
Yeah.
So I don't think they'd make the same decisions even if we had another pandemic start tomorrow.
Yeah, I agree. And I think if you look at Jerome Powell, which is the Federal Reserve Chairman, he's done in my opinion, and I know it's not popular, but I think he's done a good job of holding his ground and not caving into, the demands for interest rate reductions. And does that potentially keep mortgage rates where they're at? Yeah, but also I think it was on Friday we saw rates drop to a 4-month low, just in anticipation of, maybe the Fed reducing rates. And so I think a lot of the, natural, like, invisible hand of the market is probably going to be more powerful than, say, a rate drop, in my opinion. And I know it's not popular, but
Well, even if they do drop rates in September, it's not going to drop mortgage rates. I mean, if they drop the overnight rate, which is the Fed rate, by 0.5 point, which would be a big change, mortgage rates will not drop 0.5 point following that. I mean,
Yeah.
sometimes even the overreaction to a Fed rate drop is mortgage rates actually get a little bit worse for a day or two and then kind of settle back down to the normal markets.
yeah. So I guess what I'm seeing working with a lot of active sellers and a lot of active buyers, and kind of looking at our market and really trying to anticipate, like, is the market trend that we're seeing right now going to continue? I believe it is. Maybe not to the extreme of like a 30% increase in the months of supply, or a 30% increase in the in months of inventory, but I do think we're going to see more listings to continue to come onto the market. I do think that we're going to see our absorption rates stay relatively low. Like, for the month of July, we were at 21%. So what that means is 1 in every 5 homes that came onto the market during that period was under contract during that period. The other 80% is still sitting on the market without an offer. So that's where that, the number of active listings increasing almost 40%. You look at the absorption rate, and it's pretty low right now.
Well, and I think the people that we're working with that seem to be happy with purchasing homes now are ones that are either first-time home buyers, they want the house for themselves, they're willing to look at down payment assistance, or people that haven't self-selected themselves out of buying a house because they don't think their credit score is good enough, they don't think they make enough money. I mean, those are some myths that actually your credit score probably is good enough. You probably do make enough money if you want to buy a house. And then also just getting creative on some of the investor stuff with bank statement programs, the DSCR loans. I mean, there are still deals to be made out there. I mean, I'm working with the client right now that with the DSCR loan, with his rents, he's going to cash flow $1,000 a month, even at 7 1/8%.
Yeah, and we've talked a little bit about the DSCR loan, but just to refresh your memory, like, that's debt service coverage ratio on investment properties. We want to talk about some of the creativity with that. Like, I think they're a great product. I personally use them on every rental that I own right now or refinance. And it's just, maybe it's a stopgap, maybe it's a long-term solution, but if you want to go into that, then.
Well, the great thing about it, you're not qualifying on your income. You don't need any income. We're just qualifying on the rents for that piece of property and the payment that's going to be. So hopefully, mostly when you're getting investments, you're hoping to at least break even, if not cash flow positive, on your rental properties, and you don't have to provide any income documentation. It's really a good way to continue to, if you want to invest in real estate, to do it without having to worry about, well, I just started my own business, or I just left my job, or or I'm retired. I mean, there's ways to do it that we don't need to have your qualifying income.
Yeah, and a great product, from a strategy perspective of, like, yeah, it's based on the stability of the house or the ability to cover the debt. The other thing too is, there's products out there 5-10 years interest only, depending on your loan to value, that may increase your cash flow versus a full 30-year amortized loan, in anticipation of maybe you see a half or a 1% rate drop, and it makes sense to lock in for those, for that 30 years. But great product for even a 5-10 year loan strategy. And by the way, I think the average investment property is only held for 11 years.
Yeah, well, and I mean, in the same token, there's also the asset depletion. So if you're retired, you have all your money set up in stocks, and you want to diversify a little bit, we can qualify you on your assets over their 5-year, 10-year depletion, and sometimes even a conventional loan on a 25-year depletion. But it's a way that you could potentially, as we've talked before, put 25% down on a house and have it go up 25% over a 5-year period. And that really isn't 25%. It's a much larger gain because you only put 25% down. You're looking at nearly like 100% gain on your money.
Yeah. So if you're a buyer in this market, in my opinion, like, I do think that you can be a little more aggressive with your offers, whether it's asking for a price reduction, or maybe even just suggesting the home get in alignment with where the market's at. Seller concessions, definitely seeing a lot more of that, whether it's in upfront negotiations and or during inspections. And to your point, even just taking the first step of, is my credit score, strong enough? Is my income strong enough? From what you're saying, you might be surprised. And the creativity in our market right now, I think, is almost a necessity in, a handful of cases, maybe not all of them, but. And if you're a seller in the market, then, I think it's, at least the conversations I'm having now with my clients is, the expectation of where the home should be priced. If you're looking back 3 months, 6 months, you probably need to be somewhere in the neighborhood of 3 to 5% below that, just to align with, like, our current market environment of more inventory, fewer homes being absorbed when they come onto the market in that first 30 days, 60 days. Because if you miss the window, you're trying to find the market, and you're going to spend a lot of time figuring out like where the price should be for the market. And so, coming in a little bit lower than where even maybe the comp suggest. And I think for peace of mind, we're probably 3 to 5 years ahead of where we should be with regards to home values. And we saw them double in a period of 7 years, and that's
there's
not
no
supposed to happen.
there's no question that in order to stay on the normal trend of house price appreciation, the curve had to level off a little bit, or we were just not going to stay there. I remember talking to a friend of mine, and this is several years ago, and this was after COVID, and he goes, I think what's going to happen in Spokane is what happened in Seattle. And I said, what's that? He goes, when I first bought my first house in Seattle, I thought it was really elevated because prices had just skyrocketed, and then it leveled off for about 5 years, right? There just was no change, right? They got to the point that it was as high as it was going to go. I'm not suggesting that we're at the highest we're going to go, but it's certainly not going to continue at a rapid increase.
Well, and we saw a little bit of leveling out, like in our area after 2008. We saw it again in 2012, and then it was game on again. And so, I mean, like, we might see a bit of a pause, but historically, if you look back over the last 90 years, there's only been 7 years where we've had negative, value year over year in homes. And here locally, like, we've never had a double-digit loss, or never had a double-digit like pullback, and it's been really, really steady and isolated. So if somebody is thinking about taking the step to explore home ownership, invest, or anything along those lines, how can they reach you?
Well, that encourages you to give us a call. We can be reached at 509-747-1300 or at chimneyrockmortgage.com.
And Spokane Home Guy can be reached at 509-990-SOLD or SpokaneHomeGuy.com. Till next time.